Goody, let's take it up another notch. Funny pants, assume a VAT rate of 14%. Marty Harris is an interior decorator and party planner who has started her own decorating and party business, Funny Pants, on 1 February 2014. Marty made an initial capital contribution of $150,000 in February. Funny Pants is a registered VAT vendor. Assume that all amounts include VAT, except where otherwise noted or not allowed in terms of the VAT Act. Funny Pants uses the perpetual inventory system and charges a profit margin of 20% on cost on all goods sold. So let's quickly do our profit formula. We say, well, we know what our profit formula is. It's cost price plus profit equals selling price. So what do they tell us? Profit margin of 20% on cost. So then cost is 100. Profit will then be 20% of that equals 20. And that will give us a selling price of 120. Details of the transactions for April 2015 were as follows. And then they want from us to analyze the transactions in terms of the accounting equation by making use of this format. You can ignore that. That's only confusing for you guys. There's no impact on anything. Analyze the above mentioned transactions, date, account, debit, credit, equity, assets, and liabilities, plus, minus, and plus, minus. When something is going to decrease, you have to use brackets. Okay, let's start at the beginning. Decorating materials at a cost of 30,000 Rand was delivered in the store on 2 April 2015. The supplier is a part-time artist and is not registered for VAT. So Funny Pants had bought some of these materials. Cost of that was 30,000. This guy is not registered for VAT, so he cannot issue a VAT invoice. Therefore, the full 30,000 will be posted to our inventory account. So we will debit our inventory statement of financial position, which will increase assets with 30,000, and creditors we haven't paid him as yet. Creditors' liabilities will be credited, so it's an increase in liabilities of 30,000. Goods with a total sales value of 28,500 were purchased and paid for by EFT, electronic transfer, on 5 April. So we bought it, we paid for it, so therefore we have to account for it. So bank was credited with 28,500, which is the invoice value of the goods purchased. Inventory will be debited, so assets will increase with a VAT exclusive amount, so 28,500 divided by 1.14, that gives us 25,000. So 25,000 times 14% will be the VAT input that we can claim a debit against VAT input of 3,500 Rand. Wall decorations with a total value of 8640 was sold to the customer on 7 April on credit. Funny Pants granted a trade discount of 5% to the customer. Now, there are two things that is important. The first one that you should know is that trade discounts is you negotiate a price with a supplier. Once you've agreed upon a price that you can purchase the merchandise on, that will be your price. It's a special price. It's not a normal price. And that the invoice that will be issued to you will be an amount that will have already taken into account the trade discount that was granted. So invoice value will always be after a trade discount has been given to you. Now, the total value was 8,640 Rand. We gave them a trade discount of 5%. So this is a normal value. This is not the value that they have paid. So debtors will be debited. The invoice that we're going to issue to the debtor won't be for 8640. It will be for 8640 times 95%. Debtors' statement of financial position under our assets will increase debit with 8208. Sales statement of profit or loss will increase equity with a VAT exclusive amount which is 7,200. And then VAT output is going to increase our liabilities. It's going to be a credit against that statement of financial position, VAT output, 1,008. Now we have to adjust our inventory. Now, whenever we're going to adjust our inventory, we need a normal sales value. And this ain't a normal sales value. This is a special price sales value. So we first have to convert this to a normal sales value. They gave us the normal sales value. They say it's 8640, but that will include VAT. So we have to take out the VAT to get to the sales figure. So 8640 to get to a normal selling price divided by 1.14 gives us 7579. And now we can apply our profit formula to that. 100 divided by 120 multiplied by 7579 will give us the cost price of the goods sold, 6316. So we will debit cost of sales, statement of profit or loss, debit, decrease equity, 6316, and then we're going to credit inventory with the same amount, which will be a reduction in our assets as well. On the 13th of April, Mrs. Jones, a customer of Funny Pants, died. Mrs. Jones was a regular customer and had an outstanding balance of 17,100 Rand. A claim was submitted against the estate. It is, however, unsure whether this amount will be received as the estate appears to be insolvent. The curator indicated that he is collecting all claims against the estate, but that it is likely that payments will be made in the future. No payments will be made in the future. As a result, Funny Pants decided to write off this debt and no interest has been made in this regard. Now, initially when the sales transaction took place, we debited the debtors with 17,100, we credited sales with that exclusive amount, and we credited that output. Now we want to get rid of that 17,100 Rand in our books because we've never collected the money. So the receiver of revenue says, okay, now you can claim the VAT back. So what are we going to do? We're going to credit our debtors account with the full amount we want to write off. Debtors account, statement of financial position, 17,100 Rand. Included in that amount, divided by 1.14, multiplied by 14%, gives us the VAT that we can claim back now. So now it's VAT input under our assets debit, statement of financial position, 2,100. The amount that we're going to recognize as credit losses written off, not bad debts, guys. You are now at varsity. We don't use the words bad debts. We are a little bit more sophisticated. We are using the words credit losses. So credit losses expense account, statement of profit or loss debit with that exclusive amount of 15,000. So the debt is out of our books and we've written off that 15,000 as an expense. On 18 April, Funny Pants hosted the Spider-Man themed children's birthday party with a total price of 12,000 Rand. So total price will for sure include VAT. Funny Pants has a 5% early settlement discount policy on the total invoice amount if the account is paid in full within 30 days. It is expected that the client will not settle within 30 days. Funny Pants requires a deposit of more than 20% upon the booking of the event. The customer paid a cash deposit of 5,000 Rand on 8 April 25. Just want to put that in a different color. Oh my goodness. Let's try again. Yeah. All costs associated with the party has already been correctly accounted for except where otherwise noted. Now, what do they mean by that? Guys, that is the cake and the sweets and the balloons and the decorations, whatever. That has already been paid for, so you don't have to worry about that. This is only about this transaction where we have to collect 12,000 Rand for this Spider-Man party. Okay, so she paid 5,000 Rand deposit. What is required? From her, it is required to pay about minimum of 20%. So 20% of 12,000 is 2,400, so she paid more than the required amount. The outstanding balance was settled on 30 April 2015. Now, here are a few dates that is quite important. The first thing that happened was this deposit received of 5,000 Rand on 8 April. Now guys, you must distinguish between this type of deposit and a type of deposit that you can claim back. The type of deposit that you can claim back will typically be your water and electricity deposit with the municipality. Once you move into new premises, you have to go to the municipality, you pay them a deposit amount, and then they come and connect your water and lights and whatever the case might be. When you're going to move out of that property one day on a rainy day, then you can claim back that deposit from the receiver of revenue. Now this deposit is not that kind of deposit. What is this deposit? This is actually a prepayment on the amount that they will owe Funny Pants once the party has taken place. So you're never going to receive back that 5,000 Rand. It's not a claimable deposit. It means that that 5,000 Rand is actually a down payment on the total amount that they will owe once the party takes place. So that's the first thing that happens in this paragraph. Guys, whenever you get a paragraph like this, tear it apart and then do the stuff in date sequence as it has happened. Okay, so they receive a deposit of 5,000 Rand. Bank, statement of financial position, debit 5,000 Rand. Can they recognize the income at this stage? No, they can't. Why not? Because the party was only taken place on the 18th of April. So if they receive the down payment or the prepayment on the 8th of April, they cannot recognize any of that income as yet because they haven't earned the income as yet. The receiver of revenue will ask you whether there's a tax invoice, and we will tell him no, not yet. And then he will ask you, but did cash flow take place? He says, yeah, well, a portion of the cash flow did take place. And then he says, thank you very much. I want my portion of that cash flow. So that means that we have received income in advance, only the portion that the entity, Funny Pants, can call its own. So 5,000 Rand, 14% included in that 5,000 Rand, we have to pay over to the receiver of revenue. So VAT output, which will increase liabilities, 614 Rand. And the VAT exclusive amount, so after we've deducted that VAT, 4,386, that is the amount that Funny Pants is actually entitled on. Now, the next date that comes, that something has happened is the 18th of April. So what happens on the 18th of April? We have this nice party and the kids are running around, they're making a lot of noise and whatever. So on the 18th of April, we have actually presented a party. So when did we become entitled on the income from the party? On the 18th of April. When will we make out the sales invoice for the party? On the 18th of April. What do we do with that sales invoice? It's going to be a credit invoice because they haven't paid us in full as yet. We are going to post it in the debtors journal. How? From the source document. So we are going to debit debtors with an invoice value of 12,000 Rand. That is the cost of the party, VAT inclusive. We're going to take the VAT included in the 12,000 to the VAT output account, which is 1474. And the VAT exclusive amount, i.e. 12,000 divided by 1.14, that is going to go to sales, credit to sales, which is going to increase equity. But now, if you look at your books, you are going to have a debtor of 12,000 Rand. And you're going to have VAT of 1474. And you tell yourself, but wait a minute, Didn't this debtor already paid an amount? So yeah, how much? 5,000 rand. And haven't we provided for a portion of that VAT output as yet? Yeah, 614 rand. So we have to do something to rectify this situation. Yeah. How? Guys, we don't have income received in advance anymore because we had the party, and as a matter of fact, the party costed 12,000. She gave 5,000 rand deposit, so 12 times minus 5 gives us an outstanding amount of 7,000. Currently lying in the books at 12,000. So what are we going to do? We are going to take the income received in advance out of the books. So here we credited the liability account. Now we're going to debit the liability account, income received in advance, which will reduce our liabilities. When we posted the invoice, we posted the full VAT output applicable on the 12,000. Now that 5,000 is part of the 12,000. So in effect, we have now duplicated the 614 rand. So let's take that out of the books as well. So here we credited VAT output. Now we're going to debit VAT output with 614 rand. So if I add that and that, it gives me 5,000 rand. So the counter leg of 5,000, we are going to post against our debtors. So we're going to credit our debtors account with 5,000. What will the balance be on our debtors account now? 12,000 less 5,000 equals 7,000. Isn't that what it was supposed to be? Yes. That one and that one cancelled out. That one and that one cancelled out. So what are we left with? We are left with sales of 10,526, which is correct. It's based on the 12,000 rand. We are left with an outstanding debtor of 7,000 rand, which is correct because that's what they still owes us. And we are left with the actual VAT amount of 1,474. So I have achieved the correct entries. What is now in my books is a reflection of what has happened up till now. Now, they tell us here that Funny Pants gives a 5% early settlement discount if a client settles his invoice within 30 days. The party was held on the 18th of April, so the invoice was issued on the 18th of April. They pay on the 30th of April, 12 days after the party took place. So therefore, they become entitled on a settlement discount. Now remember, what is the difference between a trade discount and a settlement discount? A trade discount says I negotiate a special purchase price and my invoice will be issued at the special purchase price. What is a settlement discount? A settlement discount says you have bought things, this is the invoice price, but I will give you a discount if you pay that invoice within a certain period of time. So here they're going to grant you a 5% settlement discount. The Funny Pants is going to grant the customer 5% settlement discount if they pay within 30 days after the invoice was issued, which they indeed did. So how much was they then supposed to pay in total? Not 12,000 rand, but 12,000 rand times 95%, which is 11,400 rand. The other 600 rand is the 5% discount that you received on the invoice. So that means then that 11,400 is going to be paid as part of the final settlement of the party. Of the 11,400 rand, they have already paid 5,000 rand. So the only amount that is now outstanding to be settled is an amount of 6,400 rand. So 12,000, the invoice price times 95%, that is the amount that needs to be settled. They've already paid 5,000 rand, so now they're going to repay the remainder, 6,400 rand. So bank will be debited to the amount that the customer is going to pay, 6,400 rand. Now, at what value is our debtor currently lying in our books? Our debtor is currently lying in our books at 7,000 rand. So what is the difference between the 7,000 and the 6,400 rand? That is the value of the settlement discount. But does my debtor account include VAT? Yes. Does the amount that we receive include VAT? Yes. So that difference between 7,000 and 6,400 Rand, does that include VAT? Yes. What is the actual discount? Comes out of the pocket of Funny Pants. Only the VAT exclusive portion, because the VAT included in the 600 Rand, they can claim back from the receiver of revenue. So 600 divided by 1.14 gives us 526. 14% on 526 gives us 74 Rand, and that is VAT input that I can claim back. Now, another thing that is very important, that this discount is not being posted to a discount granted account. Also, if we have received a discount, there is no such account as a discount received account. And I know that you were taught about discounts received and discounts granted at school. It is wrong. Look at this thing logically. I have recognized 10,526 Rand worth of sales based on a 12,000 Rand invoice. But what was the actual amount that I have collected on the sales transaction? Only 11,400 Rand. So if I take 11,400 and I divide it by 1.14, the VAT exclusive amount is 10,000 Rand. So my sales should not have been 10,526. My sales was only supposed to be 10,000 Rand based on the actual amount that I have received for that party. So therefore, that 526, it's a 600 VAT exclusive that you have to post against your sales in your statement of profit or loss. So it's not going to an expense account, it will go against sales, 526 Rand, and then you will see that you have rectified that amount at 10,526. There was a credit, here's a debit. So what do we retain as sales? 10,000 Rand. What is 10,000 Rand times 1.14? 11,400. How much have we received for this party? 11,400. So make sure that you understand this. Make sure that sales, that you understand that whenever you grant a discount, that discount should be adjusted against sales. If it was a purchase transaction and the discount was granted to you, then you couldn't have used sales. It would have been inventory or purchases, depending whether it's a periodic or a perpetual system. Good. Just to go back here, debtors is then cleaned out with an amount of 7,000 Rand, which is the 12,000 less the 5,000, which is 7,000. I've received 6,400 Rand additional in the bank, so I've received in total 5,000 plus 6,400, which is 11,400. I've adjusted my sales to the correct figure, which is the 11,400 divided by 1.14, and my VAT then will be 1,474 less the 74 VAT input that I'm going to claim here, which is going to reduce my VAT. That 74, because it's VAT input, you could have shown it here as an increase in assets as well. I would have marked that right. Funny Pants paid 2 casual workers 250 Rand each for being waiters at the Spider-Man party. So in other words, what are we going to be paid? 500 Rand. There is no VAT on salaries and wages. So expense account wages, statement of profit or loss is going to decrease equity with 500 Rand, and my cash is going to reduce an asset with that same 500 Rand. On 23 April, Martha's mother-in-law turned 70. Martha did not get around to buy a present for her, and therefore she took a vase with a cost price of 2,000, exclusive of VAT, and a selling price of 2,400, exclusive of VAT, as a gift for her. So what do we have to do? We have to adjust our inventory record. At what value do we record inventory? We record inventory at cost. There. So we're going to show that the inventory correction will be at the cost price of 2,000 Rand. Now, what happened when we bought that inventory initially? We claimed VAT on that. And now the receiver of revenue says, I want my VAT back. So what is our total drawings? Our total drawings will be 2,000 Rand, of which we have adjusted our inventory figure for. So it's a credit, it's a reduction in our inventory. Our asset figure was 2,000 Rand. Then the VAT that we originally claimed on the 2,000 Rand, 14%, that we're going to pay over to the receiver of revenue. So our liabilities is going to increase. So it's a credit VAT output. And the two of them together, the 2280, that will be our drawings. And our drawings is statement of financial position. And that is going to be 2280. It's a debit. It's going to reduce our equity. On 1 March 2014, Funny Pants were granted a loan of 50,000 Rand by ABC Bank. The applicable interest rate is 12% per annum and it is paid monthly on the last day of the month. Funny Pants made a 5,000 Rand loan repayment on 15 October as well as on 1 April. So we have to do the transactions on 1 April. So on 1 April, we repaid that 5,000 Rand loan. So loan, statement of financial position is going to reduce. It's a debit against our liability account. And bank is going to be a credit against our asset account. So that's also going to reduce with 5,000 Rand. Now, we have made up till now 2 payments. So the original loan amount was 50,000. We have repaid 2 5,000s and we've done so on the 1st of the month. So that means that on the total month of April, the outstanding loan amount was 40,000 Rand. We are paying a 12% interest and it's a 1 month period. So that works out on 400 Rand. Remember, interest is not subject to tax, VAT. It is a VAT exempt item. So our interest on the loan expense account statement of profit or loss is going to be debited, which is going to reduce our equity with 400 Rand. And our bank statement of financial position, our assets is going to decrease with 400 Rand. Funny Pants made a donation of 1,000 Rand to the SPCA on the 24th of April. There's no VAT on donations either. So donation expense account, statement of profit or loss debit, 1,000 Rand is going to reduce our equity, and bank credit with 1,000 Rand, it's going to reduce our assets simultaneously. Funny Pants rented an additional storage space and paid rental of 6,000 Rand exclusive of that. On 25 April to Mega Storage, a registered VAT vendor. Now, if they are a registered VAT vendor, we have to pay them the VAT as well. So the 6,000 is the exclusive of VAT. Is that the amount that we've paid? No. We've paid 6,000 times 1.14 to include the VAT. So our expense account statement of profit or loss is going to reduce our equity with a VAT exclusive amount of 6,000 Rand. We have paid actually 6,000 times 1.14. That is the amount that we've paid. So our bank would have been credited with that amount of 6,840. And then the VAT is 6,000 times 14%. That we can claim back from the receiver of revenue, which equals then 840 Rand, which will increase our assets. The last one, Funny Pants sold decorative chairs with a total value of 18,240 Rand, including VAT, on credit to Mr. Thomas. 26 April, Mr. Thomas is not a registered VAT vendor. It doesn't matter. Funny Pants is registered for VAT, so therefore he has to levy VAT on all sales transactions. So remember, this is a perpetual inventory system, so there will be 2 transactions, one for the sales and one for the inventory that I have to adjust. Debtors will be debited with 18,240. Our sales would have been credited, so it will increase as equity with 18,240 divided by 1.14 equals 16,000, and then the VAT needs to be paid over to the receiver, so it's VAT output, which will increase our liabilities with 2240. The adjustment against our cost of sales and inventory, that is based on our sales value. This is a normal sales value multiplied by 100 divided by 120. Can you still remember that was our profit formula? 100 divided by 120. And that gives us 13,333. So cost of sales debit, 13,333. That's an expense account. It will reduce our equity. And then inventory as an asset account, which is going to get less. So it will reduce our asset as a credit against our inventory account.